question of this paper is pretty simple. It's very intuitive. The idea is, can we actually rely on banks' promises to solve climate change? So that's very much what we wanted to. Now, as you probably know, there is a massive need for financing to finance the green transition. And the question going back to the issue is, can we rely on private actors to bridge this gap in the absence of other direct policy tools? That's in a nutshell what we wanted to look at. So, in a way, we are not dogmatic as to whether we should use other tools. In fact, we think we should use other tools. But the question is about this idea from Mark Carney and other actors in which they seem to think that relying on the private sector is the way to go forward rather than other. And there is good reasons for that, no? Because you might think that this is a global problem, so maybe you need a global alliance. And in fact, banks over 70 trillion in assets have made pledges. In this case, we focus on the net zero commitments. This is about twice US GDP. And again, our idea is whether these net zero bank pledges contribute to decarbonization. Now, let me tell you a little bit about these promises. So, banks select targets at the sectoral level, which vary across banks. So you know, if you're a, whatever, Santander, and you're exposed to certain industries, then you focus on those industries, and then you focus on the reduction of Scope 1 physical intensity by 2030. Now, in terms of contributions of this paper, this is the first paper to study sectoral targets and commitments. There is some other work on the syndicated loan side, and there is other work by colleagues at the ECB looking at other dimensions of this issue. Something important is that we focus on the use of proceeds effectively. So one question is, what are they doing with the money? You get the funding, but what are they doing with the funding? Before I continue, let me just say that the origin of this paper. So 4 years ago, after the Paris Agreement, we did a paper with colleagues on the policy side, 4 colleagues on the policy side, in which we showed that there was a reduction in lending on the relative side, you know, the relative sides of lending to brown sectors. Frankly, you know, we wrote a box EU, and you know, the policymakers were happy, etc. But I was not very satisfied because effectively we saw that there was an increase in lending to brown sectors. So we were a bit. I was a little bit uncomfortable. So I was very happy when Pari and Emil asked me to revisit this issue, and I have to say we did not have an axe to grind. We had no views ex ante of what we are going to find effectively. So we let the chips fall where they may, and we focus on this. Anyway, so this is an example of the net zero target for the Deutsche Bank, and in this case, Deutsche Bank have a net zero targets in 4 key sectors. So what do? We use administrative data sets from the ECB. They include, now, this is 4 years. We've been working on this paper for 4 years, and we've been working on this for a very long time, and tried to understand actually what was actually going on. So effectively, we use global lending by sector. I think the global component is important, because obviously you could effectively lend outside the euro area. We have bank firm credit registry, which is one of the perks that we have from the creation of the SSM, thanks to our former Governor Mario Draghi. And then we have a credible measure of banks' portfolio exposures, we have other things that I'm not mentioning here. For instance, we know which bank belongs to whom, which might sound trivial to you, but we have to use three different data sets to do that, because sometimes the banks have different incentives regarding the size or the exposure that they have, and that would be a paper in itself. Anyway, now, the empirical setting is the Net Zero Banking Alliance, a little bit about that afterwards. The key finding is not much. So it's very much business as usual. So there is all this fanfare and talk about the pledges from banks, but we do not see a differential reallocation of banks making the pledges versus other banks. We do see a aggregate reallocation away from brown into green, but it seems to be driven by credit demand rather than credit supply, which is what you would expect if that was the. So our policy implication would be limited economic impact of these promises. Okay. So we have global lending. Again, I will go relatively quickly on the ingredients, but we have 330 banks. They are all large banks, so we try to make banks as comparable as possible. We look at the pre-trends of these banks in terms of their lending. And we have an accredit, so we have all the exposure, and we aggregate the data at the parent level using the ECB group exposure. Let me tell you a little bit about the Net Zero Banking Alliance. Now, why did we take this specific alliance, as there are other alliances? And this is by far the better organized and the more comprehensive alliance. And according to the members, it would be the more stringent. But of course, we double check our results with other alliances as well. And now, the key, when you look at whether banks are going to be the ones driving the green transition, would be, so you could actually drive the green transition in three ways, right? Either you stop lending to brown, more toward green, or you engage the borrowers you are lending to invest in a more greener fashion, or you actually look at actual issuances. So effectively it would be the divestment versus engagement. Now, the Net Zero Alliance requires banks to set sectoral targets, and there are some requests in terms of they have to be the most emission-intensive sectors in the portfolio. We have some interim targets and some long-term emissions. Now, let me show you a little bit of what it looked like. So we have the signing dates. The majority of banks sign in 2021. Column B, you see that there are a number of targets, and the majority of the sectoral targets appear in the usual suspects of power generation, et cetera, et cetera. Now, what are we looking at? The first thing I'm going to look at is who promises what, where. So the first thing is you're promising something. Are you promising of something you're doing something about? Then I will look at divestment versus engagement with a special focus on demand versus supply shocks. Now, the first point, who promises things? So, and the banks who promise are mostly, but not only, the largest banks in general. There are banks who have more exposure to brown sectors and less exposure to the green taxonomy. So there seems to be evidence against green selection into commitments. If anything, it's very clearly brown selection into commitments. So you're already lending brown, and then you promise to maybe behave a little bit better in terms of lending less to brown. So this is the global lending across sectors by banks. This is just descriptive statistics, but the bottom line, if you compare, which is difficult, so I'm going to tell you the story. Effectively, you do not see a differences when you look at the aggregate lending between NCBA banks, effectively banks who promise to do something, and non-NCBA banks in terms of lending to the major sectors. Now, you go, well, you know, so you are telling me that there's nothing much going on, but what happened in terms of actual emissions? And it is crucial to understand that there is no obligation as to now for banks or firms to provide actual information on emissions. There's a new directive by the European Commission, which has been watered down tremendously recently. So we do not have the data on emissions. The ECB calculates some data on emissions effectively, but so we spend a fair amount of time looking at verified emissions using a cap and trade scheme. So this was a tremendous. Effectively, what I'm showing you now is that not only banks lend less to Brown, but we don't see differences in terms of NCBA and non-NCBA borrowers So effectively, if you're an NCBA bank, what happened with your main borrower? And we do not see that borrower is borrowing from NCBA versus non-NCBA bank experience a different behavior. Now, let me go in the next 5-7 minutes straight to the results. So let me see, maybe we could even show something here or no? No, there's no pointer. Okay, anyway, so let me tell you the story. Effectively, what we look at here is... do you want to use it? Yeah, maybe we could do that, yeah. So effectively, opala. Yeah, here we are. No, we are not going to use this because this is too complicated. Or maybe not. Yeah, anyway, so the bottom line here is like, here we are only looking at banks who already select. So the question is, in which sectors bank that already select are they focusing on? And we see that this is the bank's targets in sector that they already have more exposure. And if you look at columns 3 and 4, it is not due to credit risk consideration. The next question is what happened with credit? Exposed. So here we move from the bank level to the borrower level, and we move on to all banks. And then what we see is that banks effectively, we look at the intensive margin, and then we see what happened in terms of what happened with banks and banks when they join the NCBA, lending to a specific target. And you see a negative sign. If you look at column 1, you see a negative side. Also, when you incorporate firm and time fixed effect. So there is a decline by NCBA banks to firms operated in targets that they have targeted, in areas where they have targeted. Now, the question is, okay, so this is good news. It's very similar to what I found last time. There's a decline in lending. The question is, we do not see that there's an increase in exit, but there is less lending to those brown sectors. Now, so fine, NCBA lenders reduce credit on the targeted sector. Now, the magnitude suggests that we are exaggerating broadly on track to meeting the targets. This is hard to say. I would say they are slow off the bat, but anyway. The question is this because NCBA? So effectively what you need to compare what's going on banks who have signed versus banks who have not signed. Meaning, you need to have an understanding of the differences in lending by NCBA banks on targeted versus non-targeted sector and compare the two, right? So you need a benchmark effectively. This is a triple diff in diff, and then we cluster at the bank level. So it's fine. Yeah, so effectively we are comparing lending to firms in targeted and non-targeted sectors after a bank adopts NCBA relative to non-NCBA banks. So if I'm signing, sorry to repeat myself, but effectively what we're looking is, I want to see the effect of NCBA on targets versus the effect of non-NCBA on non-targeted sectors of both banks. So, and again, what we find is interesting. So we initially find that there is a decline in lending to the targeted sectors, but when we incorporate, and you see on the below, firm time fixed effect, the effect disappears, which means there's no supply effects. There seems to be no supply effect, so it's mostly linked to demand effects, which bodes well with what we find, because we also see a decline in interest rates when we incorporate firm time fixed effect in our estimation. So effectively, we do not find that NCBA has been leading to a decline in the supply. So we don't see a differential effect. So basically, you're promising something, but we don't see much action compared to people who have not promised anything at all. Now, you may argue, well, the second part of the paper, but what happened with the borrowers? What happened with the borrowers in which they have set up a target? So maybe I'm lending less to Sergio. Maybe I'm lending less to Sergio, but if Sergio has promised to behave very, very well afterwards, what happened afterwards in terms of quantities or interest rates? And something similar happened. The moment we incorporate firm time fixed effects and we look at demand in this way, we see that there is no impact on the demand side. Now, you may argue, well, okay, so you are lending less to Brown. We don't see that you are lending more to well-behaved, potentially borrowers, but what happened with the money? Where's the money going? And then we look at project finance, and do banks lend more to green projects? So we look at project finance, which we could identify through an accredit, and we identify the bank share of renewables in project finance, and both in terms of bank share and the logs, we see that there's not increase in lending by NCBA banks. We see an increase in project finance in general, but not to renewables. And this, again, the increase in project finance is related to demand, blah, blah, blah. But just let me conclude with something which I think is interesting, that we use the only measure in which we have verified emissions through the ETS verifying scheme. So we go from the plant level to the borrower level, and when we see what happens after your main bank joins the NCBA. And we see no increase on firm emissions if your main bank joins the NCBA. We do the same thing with sectoral targets, and we do not find much either. So effectively, we use this administrative data set to explore whether voluntary commitments led to changes in lending behavior, but we find no evidence that this is due to systematic divestment or engagement by lenders. So we conclude that there is limited economic impact on the voluntary net zero commitments, and we believe that this supports recent efforts by government to improve the credibility, but also we actually need data. So if we don't even have data on emissions, it's not possible to have a solid assessment. Thank you.
Thank you very much, David. We're going to move to the discussion by Omar Rachedi from ESADE. Here. Let me make sure you see.
Perfect.
Yes.
So thank you so much. I thank the organizers for giving me the opportunity to learn from the paper of David and co-authors. So again, like what the paper looks like at is like the impact of voluntary bank net zero commitments on lending, and leveraging the granular data that the ECB has, and also important, also looking at global lending patterns, and looks at the effect of these voluntary commitments and find that basically they do not generate anything, okay? So similar to kind of greenwashing, these banks say, we're gonna do some good stuff, they don't, but still then they benefit from higher ESG ratings and then potentially also on lower funding costs. So like this is a very nice paper, even though they're telling an unfortunate truth. Like David and co-authors take a lot of effort in thinking how to address this question. I'm gonna focus on some little room of improvement to make the paper even better. But like if you have to take two main points out of this paper, is like first there's an important paper, the one of David and co-authors on finally checking whether banks walk the talk. And the answer is they do not. Okay, so this is like the two things you need to bring home from this paper. So the first part I want to talk about is the identification strategy. So basically what they're looking at is a triple difference regression. And basically what is the triple difference doing is comparing how lending to targeted versus non-targeted sectors change after before and after these net zero commitments, and whether this change is different among these banks that make these commitments relatively to all the other banks. Okay, so this beta 1 captures this triple difference. Now, this triple difference, that why they are doing this triple difference is that like this is a way somewhat to tackle these banks' endogenous decision on which sector they want to target whenever they want to reduce their lending to some polluting sectors. Now, in a simple diff and diff, the idea is like absent treatment. The idea is like what is the main important assumption is this parallel trend assumption, that is the outcome evolution in the treated versus untreated would have been the same. And this is valid when either treatment is random or like as good as random, conditional on observable, or somewhat driven by some exogenous shifts. Here the problem is that this is instead an endogenous decision, and so this could bias the estimate, and that's why David and co-authors rightly put this triple level in order somewhat to help out absorb part of these confounding trends. And so the first thing I want to say here is that however, the problem is that what this triple difference and difference setting does is allows to make this ex-ante parallel trend assumption to be relatively more valid. But the problem is that since this is an endogenous treatment, what cannot capture is kind of forward-looking behavior. So that the banks think that these sectors, some sectors, going to have some moving forward different expected trends, and therefore this will be violating still the parallel trends assumption. So a way somewhat to deal with that will be to focus on, say, the common set of sectors among all banks, say power generation, because this is most banks target power generation. So rather than allowing banks somewhat to play on which sector to target, if you were to make a subset on the banks making commitments only on power generation, at least there you're going to take out any concern related to targeting endogenously some subsectors. Now, so in this way, absent any issue on the membership to the Net Zero Bank Alliance, in this way, the triple diff and diff will be a valid approach. However, the problem here is that what this approach does not tackle is the endogeneity, the further endogeneity of joining the alliance. Okay, and so this is a strong selection. Like those that make this alliance are 10 times larger in total assets. This is a diff and diff between 2018 on. A lot of things happen, especially in 2020, and it's very hard not to think that banks that were 10 times larger than others have been going through the same things throughout these years. Now, a way somewhat, the way I suggest here, a way to wash out this concern is somewhat to take out, to reduce this concern on this endogeneity on joining the alliance, and way will be somewhat to instrument it. So a way to be instrumenting will be potentially to looking at the orientation of the board members. So Di Giuli and Kostovetsky, they look at, for instance, the political orientation of founders to see whether firms make zero net commitments. This will be a similar approach, but in this case, focusing on the board of banks. And so instrumenting NZBA decisions will allow you, to take out this endogenous concern and therefore to make the approach relatively more valid. The second point is more on the fact that this is a staggered approach. That is, banks has been showing in the histogram have been joining at different times from 2021 on, even though most of them throughout 2021, but still adoption is staggered. Now, I would like to see a bit more details, especially on what is the sample of banks, what type of banks you're actually considering. But what is the problem with the staggered approach is that, I mean, all the new different literature, what it tells us is a mess. That is, what you are capturing is not the average treatment effect, but it's a kind of weird weighted average of the different treatments in which some weights can even be negative. That is, usually if you have like different treatments, you could think, okay, those closer should be mattering more, like weights are larger, those far away in time should be mattering less, weights are close to zero, but in this case there are also negative weights. And so, like, here, what like the literature is telling us is like, I mean, this is an issue that biases the estimates, and there are alternative approaches to deal with that. One is, for instance, to use this group time average treatment effects of Callaway Santana. Santana has been studying with me, so I'm pushing his research. Another way would be, I mean, this is a conference jointly organized with SEMFI. It's like looking at a paper of a SEMFI professor is to use synthetic diff as Dmitry Arkangelski and co-authors, but somewhat to kind of tackle the issue of this staggered treatment. The third point is on the interpretation results. So here what you're seeing is like the lending share to, for instance, mining goes down in both net zero banks and all the others, right? And so the fact that there's no effect, right? One way to think about it is that it's not that there's greenwashing, but rather than green hashing. That is like these banks that do not announce that they're gonna cut on brown firms, but then they do. And so once you're taking this difference into the regression, you find no difference, but it's not because the banks that joined the alliance did not cut, but rather is that the other ones cut nonetheless. No? So this is to say that the zero result is unclear on what dimension it directs, whether on greenwashing or green hashing. And the last point I want to make is like, okay, so making these commitments are fantastic. You're saying you're going to save the world. You will not. It costs zero, makes you enjoy higher ESG ratings, lower funding costs. So the question is like, why not all banks do that? No? So something that I would like to see maybe a bit more discussion will be along these lines. And I mean, since you're not stopping me, I can go on the last slide. Would be like, I mean, 1 minute would be, okay, so there's also some potential for like further heterogeneity here, no? That is, maybe if you're a bank in which many of your customers are connected to the brown firms in your portfolio, I mean, we know from Janetti's ID that maybe you want to take into account your entire portfolio, and so maybe what you will do is like you will try to cut to brown firms which are not connected to green firm customers which are on your loan portfolios. And so here maybe you can exploit input-output linkages to test whether this is somewhat a potential action mechanism in your data, and that's it. I'm done. Thank you so much.
Thank you, Omar. Maybe I could gather some more questions before and you answer all of them together. Is there any question from the floor? Immediate reaction? No? Yeah. So you want to answer? Okay. Sure.
Yeah, apart from these different meetings, you have this resolution agreement across time. You can find a now result which is, fully speaking, positive or negative, and you can find a positive or negative result which is not now. So you know, like the bias can go up and down, as Omar said. The other thing is that you have this result with fixed effects, but not with time fixed effects. And also, just to make the point of Omar more clear, is that maybe when you don't have a substitute, you cut it. When you have the other substitute, because these are all European banks, they are all cutting. So then within a time fixed effect, you wouldn't find the effects. But they are cutting, they are cutting, they are cutting. And you find the cutting when you don't have an alternative bank.
Tough job. Yeah, please. Let's give some time to David to respond. I don't see more hands raised, no? David.
So thank you very much, Omar, for the very thoughtful discussion. I think you raised two key points, which are also connected to what Jose was mentioning, which is, the first point is that, look, they are all declining lending to Brown anyway. And that's true. There's no way for us to check that out. So this is something we don't look at. We look at the differential behavior from those who promise versus those who don't promise. So this is something we don't look at. And I'm very sympathetic. This is 3 years' work in terms of looking what's going on. I'm very sympathetic to the political economy. And I think the political economy is something to be worried about because the trend seems to be on this direction, but something which I think is natural to ask. What will happen in Germany, for instance, when certain political options will take power in terms of the brown versus green? So this is also attached to that. No? So, okay. Now, regarding the actual comments that Omar had, very quickly, so it would be incredibly unlikely that there is a demand shift at the time from the borrower side at the time that the NCBA banks join. So we have pre-trends for joiners and non-joiners, and we see not much, we don't see much. We've done Santana, we've done Staggered. We also have compared the results with early joiners, so just the banks who joined at the very beginning. And something I didn't show you, which speaks to our results, is that we see that the impact is much higher if countries implement other policies. So we classify European countries in those more stringent and less stringent, and you do see an impact. The same way that after the Paris Agreement, you see a relative change in the behavior of US banks after Trump withdrew on the Fed, so the political economy again. And Professor Hasselman had a very good point, I think, which is, look, some of the banks actually withdrawing, and I'm not sure, but in the German press, there was a big complaint by the chairman of both the UBS and Deutsche Bank said, look, we live on the real world. We do not live on the NCA world, which means that it's costly for them to join in terms of maybe political economy, but actual lending they're doing. Thank you so much again for the great discussion.
So let me thank both David for the excellent discussion, excellent presentation summarizing 3 years' work, and Omar for the excellent discussion. And we move to the second paper of this session by Andrea. Is that one? Yes. By Andrea Polo on climate risk and lending and monetary policy. Can we have them? Yeah. Here. Would you need the pointer? No? Okay. No.
Okay, many thanks for the invitation. So the paper fits well from the title, you see, fits well with the previous one. So the two research questions we're asking is whether banks independently whether they commit or don't commit, no? Going back to one of the comments, incorporate this climate risk in their lending decisions, okay? And whether monetary policy change these, if there is a climate risk premium, so if they charge more, the brown firms, whether monetary policy changes this, okay? And this is relevant because we understand whether banks help us with this climate transition and whether central banks, on the other hand, can do something to support this role of the banks. So specifically, we ask whether banks price this climate risk, and exactly in the same definition of David. So we're thinking of transition risk, so we're thinking of carbon risk versus physical risk, when granting their loans. And in general, we don't assess only whether we're looking at the current emissions, but also we're interested in the forward-looking emission. Okay? So the plan to reduce emission, whether these two different measures of climate risk are priced or not. And in a sense, we will also dig a little bit into this issue, whether the banks which commit, they do these things differently. But then the central question of the paper is whether monetary policy affects this pricing of climate risk, and so in which direction. So in a sense, we are going to check whether there is a so-called, such a climate risk-taking channel of monetary policy. Okay? There are many models of risk-taking channel of monetary policy, and maybe we can extend to encompass this climate risk dimension. Okay? If this is the case, monetary policy expansion, banks lend more, they reduce rates, and they would do this more to brown firms, which are the riskier firms. No? So there is a lot of evidence that security markets price climate. No? There is this big debate on greenium. Now there are recent surveys where they say, okay, basically we can conclude that in many of these assets there is these greenium, stock market, option markets, bond markets. For credit markets, the evidence is a bit limited because we know something, but this is for syndicated loans. Now, syndicated loans in Europe are around 10% of credit markets. And here also for syndicated loan, there is a paper by Stephen Ongena who say, no, there is not. If you compare bonds and loans, well, there is not much in loans, there is in bonds. While another paper said, well, no, after Paris Agreement, we see something. The issue of commitment, there is, again, a bit of debate, because so there are papers like the one of Caterina here and Maria Assunta, which says, well, when banks speaks a lot about this issue, they actually don't walk the talk, in a sense in line with this net zero alliance of David. On the other hand, Jose Luis here is a paper where instead they find that the one after the Paris Agreement, the commitment via SBTI, which is a different type of commitment, this seems to be actually associated with reduction in lending. And as far as we understand it, there is nothing on this issue of monetary policy, whether monetary policy has an impact on these things. Okay. So risk-taking channel on monetary policy, the idea is that when there is monetary policy expansion, banks lend less, lend more or reduce rates, and they do this more to riskier borrowers. No? So there are several theoretical reasons. There is no one theory model of this. There are this paper of Acharya, Naqvi, which says, well, if there is abundant liquidity and the loan officer is related to the pay is related to the quantity of the loans, is abundant liquidity, this guy will reduce the monitoring effort, lend to the marginal borrowers, which is riskier. But there are other models based on the sticky rates. For instance, when rates goes down, since banks or institutions they target, then they, in order to get yield, they go to higher risk. There is plenty of evidence of this now in this institution, with data from this institution. There is this famous paper which says that when interest rates went down, less capitalized Spanish banks lend more to riskier borrowers. And there is now this paper which is more related to us, this Anderson and Cesabianchi, say when there is monetary policy tightening, credit spreads go up, and they go up more to riskier high leverage firms. Okay, so here the prediction is that maybe we can expand to, if there is a risk, this climate is risk, maybe we can expand to climate as well. So, and therefore, here what we think is that, well, okay, then monetary policy tightening should be more restrictive for the brown firms rather than for green ones. So these are unaccredited data from September 2018. Remember, this is the first moment where we have this data to December 2022. For each credit, we're interested in interest rates, in price. Going back to this question on this morning, whether price and quantity, we're interested in price specifically. And we're interested in a measure of risk, of traditional risk, because we want to control for traditional risk. We don't want to capture traditional risk. And so we also have the PD, the probability of default, the banks attribute to the borrowers. And then we merge this with data from Refinitiv on listed firms, emissions, so current emissions, scope 1, scope 2, but also their plan, their declaration that they will reduce or not their emission. Okay? Now you can say, well, a declaration by the firm to reduce, this could be cheap talk, where there is now a paper by Bolton Kabersinski, just published on the Management Science, which says, well, actually the one which the companies which declare they will reduce in this carbon protocol, actually we see a reduction in emission afterwards, and they find that in Europe there is a higher, so firms tend to declare more if they are the emitters. So the high emitters, so the polluters are the ones who do declare more that they will reduce. Then the funny thing is that globally, so if you go North America and Asia, they find that the ones which declare that they will reduce are the ones that don't pollute much. Okay, so this is different in Europe. Okay, we complement this data on banks commitment. Since at the time there was this paper, not the Kapelsinski-Pedro, and Kapelsinski-Pedro were using this SBTI commitment, we use this SBTI commitment for the banks to see whether these banks committed. And this is a kind of this is a commitment which with medium target, there is an external validation, and we look at this, whether this matter. And then for monetary policy, we look at monetary policy shock, high-frequency monetary policy shocks. Okay, so descriptive statistics here, the only thing I want you to pay attention on is that, so we're talking about listed firms, okay, in Europe, so this, and we're looking at the spread, so spread meaning that we remove the reference rate, no? So the interest rate, but we remove the reference rate, and the average is 150 basis points, and the standard deviation is 76, okay, so it's pretty compressed. And carbon, so it's interesting to see that, that in Europe, the 90 percentile of emission is 0.5, which is thousands of tons divided million of net revenues, dollars, it's 0.5. Now, if you go globally, it's 1. So the European companies are the ones which pollute less. Around 58% of our data are firms commit to these, to reduce targets in the future. Okay, so if we don't do anything, if we don't touch the data, and we just look at the interest rates between these two different groups of firms, on the left-hand side, we see firms with high carbon emissions and low carbon emission, and we find that the spread are lower if you are a green firm. Okay, so firms with low carbon emission is the green one. The same if you have a target. So if you declare a target, the rates are lower than the companies which don't declare a target. Okay. Now you see a spike. The spike comes in 2022 due to the increase in interest rates, and the spread went up. Now, what is the size of this? Is the average is around 14 basis points in the first graph, and 20 basis points in the second. Then we want to do this in a regression, and we control for PD. Now, hold on this. I've lost a lot of my nights on this, so I'll come back on this, on why controlling for PD, what does it mean. So we want to control for a measure of risk, okay? But let me come back on this. So if we control for a measure of risk, so these two variables go in the opposite direction. So if you have high emission, you have higher interest rates. If you declare a target, you have lower interest rates. Okay? And if we multiply these two, we find that this mitigating effect of declaring a target is particularly large if you have high emission. Okay? What are the economic significance of this? So 4 basis points for high emitters, 10 basis points for firms committed to reduce emissions. Is it large? Is it small? Well, I told you that the standard deviation of this is pretty small, 76 basis points. So in percentage of standard deviation is not trivial. And the other thing is that this is in line with the other papers that we have on greenium, for instance, in syndicated loans, which is around 7 to 10 basis points, or in bonds, which is around 6 basis points. Okay. Now, so we have a series of fixed effects. So bank fixed effect, time fixed effect, industry location size, the same sector, the same size, at the same, for the same industry. And then also industry location time, firm fixed effect, we cannot put firm time, because firm time is exactly our variation. Okay. Now, let me say this, why sometimes I didn't sleep. PD. So I want to control for PD. But what if PD already incorporates climate considerations? right? Because PD is the probability of default. So what is transition risk? You are afraid that in the future the government come in, put a tax, and this guy and this company suffer and they cannot repay. Okay, there are some theoretical reasons for which I could take some sleep, because the horizon is different. So PD is defined as the probability of default within 1 year. Now you may imagine that climate risk has a much longer horizon. Now there are no incentives at the moment to incorporate climate risk in PD, because the regulator is not asking you so far to do that. The other thing, how do you do it? So banks, this is what they say, maybe you would like to do, but how do we do it? PD is a Z-score. Z-score is a statistical method based on the past. How do I incorporate this? I add an epsilon. Empirically we find zero correlation between PD and these two measures of emissions. And then if we remove PD or we put firm observable, we find similar results. So I got a bit of sleep afterwards. Now, commitment. So our variable, we want to see whether there is a bit of heterogeneity in this pricing of climate risk by banks. We commit with SBTI, and we do find that, in fact, the effects are larger for these banks, around 16 basis points less for uncommitted banks. In lending to firms with target for the committed banks, so it's a type of for committed banks with a target, and a bit more for firms with high emission. But then let me go to monetary policy, okay, which is the central part. Now, the question is, when you increase, so you have monetary policy shock, you should increase rates. And in the first column, you will see that by monetary policy, you increase the spread, okay? So the spread go up for everyone. Then traditional risk-taking channel of monetary policy, let me do the interaction with PD, so the traditional type of risk, and we find that this is significant in this direction. So you increase the spread in particular for the riskier borrowers, the traditional risk-taking channel of monetary policy. Now let me add instead my variable, this climate risk variable, on top of the one on the PD, and we find that also there we find significant results in the direction that we expect. So that is the increase in interest rates has a bit of an additional rise in premium for high emitters, 1.4 basis points, and 5 basis points smaller mitigating effects for the firms which declare that we reduce emissions, so opposite direction. Then we say, well, monetary policy maybe it's not just on impact, okay, maybe it's with lags, and so we look at local projections. And if we look at local projections, what we find is that so the first graph on the left is just monetary policy. So when there is monetary policy, do spread increase? Yeah, increase at the beginning, so 25 basis points lead to around 40 rise in premium, and then so 40 basis point premium after 12 months, so increase a bit and then it goes up. There is an additional 2 basis points for high emitters, and 5 MTP as basis points, as we already seen, for the firms which commit, which goes up to 9 basis points after 1 year. Then the other question is that this is price. What about quantity? Well, I still have 10 minutes. I speak too fast. I can drink.
You don't need to stop. Go on.
We can start talking about something
go
else
on,
later.
go on.
So then the question here is to say quantity, no? Why quantity is important? Okay, we started the paper on price, because there is this greenium. But then, of course, quantity is important, because going back to the point of Solis before, price and quantity in banking helps us to say something about where demand or supply. So we look at quantity and we find a similar picture with the opposite sign. No, but we don't find much on impact, but we find that there are lags. So 25 basis points increase with the first picture. There is a negligible impact on impact, negligible impact effect on impact, but then there is a reduction of 2.5 percentage point after 12 months in general, no, for everybody. And then there is an additional 2.7% drop for high emitters after 12 months. And instead a mitigation, so you remember always with the opposite sign, no mitigation of this effect for if you are a firm which commit to reduce emissions. Okay. Now, the question is that monetary policy shocks is an identification strategy that we are using a lot, because it's the frontier, but there are also concerns with the high-frequency identification shocks. So what if we do a different strategy, that we take the change in the monetary policy stance in December 2021? Remember, the cycle starts in July, but the first time that the ECB signaled that is going to change the monetary policy stance is the quantitative tightening of December 2021. And here again, if I do the same results and I look at the spreads on the polluters and the spreads of the firms that wants to declare that they will reduce emission, we find they go up for emitters and they will go down for the one which declare that they will reduce emissions. Now, a concern, I think it's a nice identification strategy, but I had the concern, again, lack of sleep, because I said, well, there is a climate stress test. The climate stress test is exactly in 2022. But the nice thing is that, so I have a student at the Banco of Italy who is doing the PhD, and she's working on climate stress test, and the announcement of the climate stress test is in November 2020, so outside the picture, my pictures, when the ECB for the first time published this guide on climate-related environmental risk, and in this document they say, pay attention that at some point we will do a climate stress test. And she finds that there's a reaction exactly on the month of the announcement. The other thing is that in the climate stress test, of course, all the significant banks were involved, insofar that all the significant banks had to send these questionnaires to the ECB, but actually the banks which participate to the actual stress test were only 41, and we removed them, and we still have the results. Now, the last picture is this. For the first time, in July 2023, the ECB, in the bank lending survey, added a question about climate risk to the banks and say, well, what do you do with this about climate risk? And I mean, of course, I do not have a time series, I have only one data point. But this is July 2023, and they ask, what did you do during the last year? And the last year has been a year of very high interest rates. And what they say, so terms and conditions, this is basically price. Credit standards, this is, you can think basically as quantity. And the black bar is the net percentage. So it's the difference between the percentage of banks that declare tightening and the percentage of banks that declare softening. So what we see is that there is more tightening from brown firms and instead expansion to green firms. And with the data at the ECB, we could also see which banks were doing this more. And in fact, in particular for the green firms were the banks which committed via SBTi to do this more. Okay, so let me conclude. So we find that these banks charge higher rates to firms with larger emissions in general, and lower rates to firms to commit. And the commitment via SBTi seems to matter insofar as these banks do it a bit more. And we find this evidence of this climate risk-taking channel of monetary policy. What is the bottom line? Why this is relevant? Remember that at the point of the ECB, when there was a tightening in 2022, one of the concerns, there is this famous speech of Isabel Schnabel, one of the concerns is that by increasing rates, there is the chance that we stop the transition, right? Because you increase rates, everybody suffers, and firms who need to do the investments to move technology, they cannot do it. Now, what we find is that, well, yes, it could be the case, interest rates go up for everybody, but via this climate risk-taking channel by banks, the ones which are more penalized are the brown firms, and less the ones who instead want to decarbonize more. Many thanks.
Thank you. Thank you very much, Andrea. Let's move to the discussion. I believe it's this one. Yes. By Sergio Mayordomo from Banco de España.
Thank you. So thanks a lot to the organizers for the opportunity of discussing this paper. I think this is the third or fourth time that I've seen this paper, and they have addressed a lot of the comments that I've seen, so it's not difficult to do this discussion. So the paper is great, because I think this is the first paper that considers not just climate risk, but also monetary policy. So the two main research questions and the answers, the first is, do banks spread climate risk? And the answer is yes. Not just current climate risk measures, which is measured through the emissions, but also future exposures, which is measured through the targets, no? To the commitments of the firm. What is very nice is that the effect is stronger for banks that are committed, no? to do these environmentally responsible lending policies. And the second part of the paper, that to me is the one that contributes more to the literature, is the one that considers a new climate risk-taking channel of monetary policy. So it extends the standard risk-taking channel of monetary policy, and what they find here is that when there is contractionary monetary policy, the cost for brown firms increases, the quantity that they can obtain decreases, and the efforts, in some sense, are milder for the firms that are committed to decarbonization. So I think that this is the very nice contribution. This is very unique in the literature. So I have 3 comments. The first one are related to the first part of the paper. So when the authors study climate risk and loan spreads. The first comment is a very easy comment and probably unfair, but it's true that all the measures trying to deal with the emissions and the climate commitments are firm and bank choices, no? For instance, the emissions, they are voluntary. In many cases, they are an estimation. So I'm not saying that is wrong, but probably you can do something else to deal with this. The firm target is also a firm choice. So you mentioned that there is a paper that showed that when there is a target, they commit and they decrease, no, the emissions. But I think that that would be nice also for your sample to show that they invest to reduce carbon emissions or that they are really reducing carbon emissions. The bank-related variable is also a bank choice. I mean, their commitment. No, I mean, the previous paper by David said that there could be some limits, no, based on the commitment of banks for decarbonization. It's true that the measures are different, but I think that this is a common weakness in the literature, and I think that could be nice to exploit some shocks that are specific to some countries or exploit pressures affecting specific firms or banks, or something like Omar was suggesting before, no? To use some type of ESG orientation of board members in order to deal with these bank commitments. Another possibility probably is to use the data vendor estimated or the ones that David had in order to say, look, I have the same results if I use these self-reported variables or if I use a different one. So my second comment about this part is about the potential role of relationship lending, right? So I really like these results. The point is, if I focus on table 2, that is the one that the column that uses industry location size times fixed effects, that is the one that I like the most. The absolute value of the effect associated to the target, that is to the commitment, is almost 7 times larger than the one associated to carbon emissions. So the effect is 1 basis point, it's true, it's small, but the one associated to the target is very large. So my point is that probably banks are rewarding for setting climate risk targets. And this is very new, and this is very nice. So I think that the authors, in fact, have some nice results when they interact, the carbon emissions and the target, and this is very robust, and they say that there is an extra discount in the price there. So probably there is something related to relationship lending here, no? There is a recent survey by Aguilar and co-authors, a survey to bankers, and they say that they try to prioritize long-term relationships with their clients. So in some sense, they say, look, we are not going to get rid of the dirty clients. What we want to do is to help them, in some sense, to go towards a transition path. And this is something that is shown also in the paper. So it's consistent with this survey, and I think that probably it explains the differences in the results referred to the emissions and the target. And I think that probably you can test very easily, if it's the case, considering new brown firms. So when they don't have previous relationships with the firms, are they increasing the spreads or not? My second set of comments is related to the case in which they interact not only climate risk, but also monetary policy with these emissions and commitments. So my first comment is about the data aggregation. No? I mean, the dependent variable here is the interest rate of a given loan minus a risk-free rate. Depending on whether the loan is fixed or floating, we're talking about that over the lunch. They consider the fixed rate, they consider the swap with a similar maturity. For the floating, they consider the reference rate of the mortgage. Once they have this spread for each loan, they aggregate all of them through a weighted average in which the weights are proportional to the loan size. So the point here is that loans could differ a lot across countries, as we know, and across firms, so there could be a composition effect here, and I was wondering whether it would make sense to use individual loans at origination rather than aggregating the information in this way. So if the authors continue with this strategy of using loan portfolio, I think that there are some interesting controls that could be used here. For instance, the residual maturity of the loan portfolio because the term premium could be different to the one observed for the risk-free rate. So there could be a risk premium in loan spreads, the loan age, the proportion of fixed floating, and so on. My second comment is about the period that they use. No? I mean, they use local projections. I think that for using local projections, it matters, no? The length of the sample period. And as you can see in the left figure there, I don't know if it works, you can see that the vertical line refers to the end of the period. But there is a lot of tightening, right, after December 2022. So I think that extending the sample would help you in order to improve the local projection exercise. And what is interesting, probably you can consider the easing as well. My second point is in favor of the authors. No? You focus on the first figure, you see, in which we have the new bank loans, that is the cost of the new bank loans. Since January 2022 till December 2022, the cost increased by 200 basis points. But the authors are using the stock of credit, so they are using the amount outstanding. And if you go to the right figure, you see that it takes time, right? So, I mean, the period that you are using, you see that the increase in the corresponding interest rate when you consider the portfolio is just 70 basis points. So probably the effects are not so small. The issue is that they are referring to the stock of credit, and if you consider the new loans, probably the threat is larger. So 7 basis points based on this is like 10% of the increase that you see for the stock of credit. The other comment is about which is the real channel of this climate risk channel of monetary policy. So the authors say in the paper that when there is contractionary monetary policy, banks could increase the monitoring efforts to see the emissions of the firms, and then cut lending to the firms that are high emitters. So my point here is that they are large corporations, they are listed firms, so this information is public. So through which channel occurs this monitoring? Why is different to consider this in terms of firm heterogeneity? And the second is why emissions monitoring would be stronger during tightening of monetary policy. So the other alternative is to based on risk taking, right? But I think that here it would be interesting to know that, I mean, probably brown firms are not riskier, as you say, but I think that one is here to split separately the climate and the credit risk. And I don't know, probably the PD has a nonlinear effect, the one that you are using, and one could use, for instance, I don't know, industry location size, risk buckets, and time fixed effects in order to compare firms that have exactly the same level of credit risk. So in some sense, why good transition risk materialize more in monetary policy tightening, I think that's something that have to be better explained and addressed in the paper. Probably this is a reputational risk channel. My second comment is, my last comment about this part is you merge floating and fixed rate loans. So the floating are established before, so it would be nice to split them because, I mean, floating rates represent more than 60% of the loans granted. So they are very different. The way in which you clean them, the way in which you obtain the spread is different depending on whether they are fixed or floating. So I think that the split of these two types of loans would help to understand the results. Another comment is about something that you mentioned in the paper. No? You say that there is a slowed down investment aimed at reducing carbon emissions. So restrictive monetary policy could lead to this. So I think that this is something that you can test in the paper, and probably you don't do this, is just considering the triple interaction of the monetary policy shock, the carbon, and the target for interest rates and for quantities. And I think based on this, you can give an answer to this question, whether really contractionary monetary policy is slowing down investments or not. Also, the role of committed banks. No? I mean, you consider committed banks when you analyze what happens with the emissions and the targets, but what is the role of, let's say, committed banks in the transmission of monetary policy? And this is something that can be addressed very easily in the paper, and I think that it could, in some sense, complement the first part that you saw. And my last comments are related to the effect of quantity. No? Here, you saw that lending to carbon emitters declines for all banks, but committed banks decrease lending much more. So I think that you can align the findings with the loan spread part, considering this effect of commitment and so on. And in the BLS, it's true that you report separately green and brown, but I think that merging all of them and to show whether you obtain the same result based on some statistical tells would be helpful. So you find that there is not an immediate impact in terms of loan volumes, but it occurs gradually. And here is where you use the local projection. So I think that extending the period would improve probably the results in that part. And something that I found in this section is that there are no firm controls when you try when you estimate these local projections. So I think that the loan size could be correlated with some firm characteristics. For instance, the size, probably brown firms are smaller, and it explains the lower amount of credit, or if they are larger, probably they are able to tap funding in financial markets. No? So it would be nice also to see whether credit is reallocated towards firms with targets instead of focusing on the differential effect. In some sense, whether carbon emitters can substitute banks such that they can switch their lenders. This is something interesting. And that's all. I have many comments here, small comments, but one is that I think that you have a great opportunity to compare your paper with the literature on syndicated loans, and then you can see why do they obtain different results. And there are many puzzles in the literature, and I think that with the data that you have, you can do a lot in those terms. So thanks a lot.
Thank you, Sergio. So we have now some minutes. Let me, before you prepare to answer, Sergio, let me gather some more questions. José Luis, there.
Yes, so one question is, thank you. So you're analyzing transition risk, not physical risk. And I guess you are analyzing scope number 1. So this takes time, no? And, you know, we might think, I don't know, 3 years, 5 years, 10 years. And the monetary policy, these surprises could be shorter, could be more 5-year forward guidance, or could be QE more 10 years. So it will be super interesting to see what these differential effects of monetary policy, whether they are different depending on the QE, forward guidance, and shorter interest rates.
Any more questions? So while you prepare the next round of questions, let's give the floor to Andrea.
Okay, not to José Luis. So we use the target, which is the one which consider all the term structure, but give more weights at the short term. But we could look at the long term versus short term and see where the effects are. Wonderful suggestion. So many thanks to the organizer for giving us these excellent discussant. So these were all good points. So I just took a very long to-do list. So many thanks. So just a few clarification. So for instance, you mentioned this thing called the PD. No, the PD, of course, is given only by the RB banks, and but we take the average of the PD so that we don't consider only RB banks. No? We can consider all the banks. The important is that at least there is one RB bank, so that we can have that can construct the variable. This non-parametric controlling for credit via non-parametric is important, and you gave us suggested the way to do it. This triple interaction in a kind of speak exactly to the issues of the decarbonization and the monetary policy, which so it's a very nice way. We didn't think of this. The reallocation is this coming from divestment? No, as David was saying, it's coming from the divestment of the brown or more investment in green. So we can also we can do this split versus fixed versus floating. So just a very useful list of super useful suggestions. Many thanks.
Any more? We still have a couple of minutes if you want to pass more questions. Any? No? Rafa.
Why is it that you are referring to transition risk and not the combination of transition and physical risk?
I don't think there is an answer to this question, and the answer is we should look also at physical risk. So we think that so we started a project with this issue of transition, but we can do exactly the same because we think that exactly the same is at play with physical risk. So if physical risk is a risk that is priced by banks, we think that it should behave exactly in the same way, and we want to expand the sample to do exactly what you suggested. No, we can distinguish. We can distinguish in the sense that for transition risk, we think of the firms polluting, no? And here we use emissions or the decision to decarbonize by the firm. Instead, for physical risk, the way we interpret physical risk is to say firms which are subject to the fact that if there is an earthquake, they suffer. And so typically, the heterogeneity that people use at firm level is to see whether firms are close to as close to place where there are typically earthquake or there are flood. So there are other measures of physical risk that we can use exactly in the same format, in the same structure of what we are doing.
More questions? So I think we all, but especially the presenters and discussants, deserve the coffee break now. They did an excellent job. So let me close the session here, and we break for a short coffee break now. Thank you again.